Good morning, distinguished ladies and gentlemen. All protocols duly observed. My name is Ademorayo Akbara, and I am a first banker. I'm delighted to be here this morning, and permit me to wish you a Happy New Year. I know many people would have wished you a Happy New Year. It's the 8th of January. Well, permit me to wish you a Happy New Year. I pray that this new year will be good, great, and grand, and everything that you wish for it to be for you. Amen. The beginning of a new year, it's a time that gives us the opportunity for a fresh start, seeking for answers and what the year would look like, context, and insights into how to position. And so we are here today at the 2025 FirstBank Nigeria Economic Outlook, where some of these questions we would try to answer. We've got panel discussions and expert keynote addresses that would attempt to answer the questions on your heart as far as it concerns economic situations and trends within the country in Nigeria. We have seated today, lined up for you, keynote address to showcase economic trends, expert focus, and what to look out for, headwind and tailwind. All you require pretty much to set you up for a great 2025. FirstBank, the bank that puts you first all the time. We have done this for several years, and we are here again to ensure that your year starts off and kicks off on the right note. I think it's a great time to appreciate FirstBank, if you agree with me. Thank you very much. Our theme for this year, Nigeria 2025. Pathway to economic rebound and recovery, is what we'll be looking at, and what exactly businesses, individuals, small, medium scale enterprises, and large corporates, what do we need to do, and what are the things that we should look out for? I'd like to acknowledge the presence of everyone in the room. Thank you for spending your morning with us. The senior management board, staff of FirstBank, and our esteemed customers that are seated here. Special shout out to everyone joining online. We acknowledge you. I know that there are people from across the world in the different parts where you're joining from. Good morning, good afternoon, good evening to you as it applies. We value your presence and we do not take it for granted. Thank you for being here. To kickstart this conversation this morning, I'd like to bring to the stage, he will be joining us virtually, the first man for FirstBank of Nigeria, the MD CEO, Mr. Olusegun Alebiosho. Please confirm to me that he's available to take his opening remark. Great. Thank you very much. A round of applause as we spotlight the MD. Can we have volume?
My remarks by taking the opportunity to wish you and your loved ones a happy new year 2025. We made it to 2025. As we all know, 2024 was an unusual year. But the Nigerian spirit is an undaunted one, where we all all optimistic in the face of harsh realities, believing that tomorrow will be better. And we have been seeing that year on year, and we can sit back and predict that after every harsh period, good period follows. Due to the impact of some of the painful but necessary reforms that the government had pursued, inflationary pressure exerted considerable strains on households and corporate incomes in 2024, with inflation rate reaching a three-decade high of 34.60 in November 2024. And in response, the Central Bank of Nigeria, through its Monetary Policy Committee, had steadily raised the benchmark monetary policy rate, MPR. We now have it at 27.5 in a bid to tame inflationary pressures. The combination of these actions has resulted in significant higher costs of living and operations and funding for household and corporates. And I've seen that. Corporates will always say, nobody can grow, nobody can do business at this rate, which is true. So we're seeing a lot of pressure on households and corporates. Nonetheless, the Nigerian gross domestic product (GDP) grew steadily quarter-on-quarter basis in 2024, growing the most by 3.4% in Q3. We don't have Q4 numbers. Similarly, signs have begun to emerge that the reforms pursued by the government are starting to yield the desired results. For example, the improving government revenue and fiscal positions, as suggested by the better revenue to debt ratio of 8%, and the growth in revenue and foreign reserves balanced to about 40 billion, are indicators that our optimism as a people will not be in vain after all. In addition, early signs such as the stability that characterizes the foreign exchange market on the back of the introduction of the electronic foreign exchange matching system in December 2024, the emergence of competition on the supply side of our nation's downstream sector, that is leading to falling prices in premium motor spirits, and the coming back on stream of the Port Harcourt and Warri refineries are indicative that there is indeed light at the end of the tunnel. I always refer to 2024 as a year of miracle. I call it a year of miracle because I never believed in my lifetime that Nigeria will be able to exit fuel subsidy. Fuel subsidy that we have been fighting since 1985. Over 30 years, or 40, almost 40 years, or 40 years now. People have been fighting to get fuel subsidy out. That was achieved in 2024. And you can imagine the savings for the economy. And we've all adjusted. And now you are seeing PMS price coming down. Very good for everyone. And you save yourself $700 million everyone. We've seen positive accretion to reserves. And we've seen changes in the economy itself. No one believed this a year or two down the line. As a thoroughbred Nigerian myself, the sheer timing of the emergence of these developments has strengthened my optimism about the Nigerian economy, especially coming into the new year. Also, the government proposed $49.7 trillion budget is expected to provide sufficient economic stimulus in view of the lower likelihood for poor budget implementation due to the improving government revenue position. Therefore, the projected GDP growth rate of 3.68 for 2025 is very likely out. As a bank that has done business in Nigeria over several economic cycles, FirstBank remained poised to to work with our customers through this difficult yet promising stage of our nation's journey. This event holding today and its chosen team, Nigeria 2025 Path to Economic Rebound and Recovery, reflect on our institution's understanding of the domestic realities, but more importantly, our readiness to partner with our customers to identify emerging opportunities within the economy. We properly equipped towards achieving both personal and corporate goals in 2025. At FirstBank, we are committed to supporting our customers with innovative products and services that can help cushion and manage the impact of economic realities, as well as enabling our customers to combat distinct opportunities in the economy. As the premier financial institution in Nigeria, having operated successfully for over 130 years, FirstBank has unparalleled local knowledge and capabilities that our customers can leverage to succeed in 2025 and beyond. It is my firm belief that 2025 is pregnant with potentials for designing businesses, individuals, and I hope that the deliberations we will have today will offer the necessary direction and actionable insights that we all can leverage to truly make the most of the new year. Finally, ladies and gentlemen, I make you a solemn promise that at the FirstBank Group, we will firmly uphold our brand promise to put you first in 2025. And once again, I wish you all a very happy and prosperous 2025. Thank you for listening. Thank you.
Another round of applause for the MD, please. Thank you. I mean, very interesting. I love some of the comments that the MD made. 2025 is pregnant with opportunities. We do all believe that. And today, we will be sharing with you actionable insights to leverage and take good use of those opportunities. I'd like at this juncture to bring on stage the head of strategy and corporate development FirstBank, Mr. Chike Uzuma, who would anchor the next segment of this event. Thank you. A round of applause for him.
Thank you, Moray. And thanks once again for joining us. We would like to extend our appreciations for those joining virtually. I understand some of them joined 30 minutes ago, but because we had done a 30 minutes networking provision on the agenda, but they couldn't network online. But we apologize for waiting 30 minutes before we start this. So, again, once again, you're welcome to Nigeria 2025, the pathway to economic recovery and rebound, organized by FirstBank Nigeria Limited, a first holdco company. Today, we've invited a very erudite economist as the keynote speaker, and I wish all of us to welcome our keynote speaker, who is in the person of Dr. Adedipe. He is the founder and chief consultant of B.A. Adedipe Associates. The person we are talking about has over 44 years experience within this space. He's worked across several industries as a consultant, as a practitioner. He's a thoroughbred economist. First degree, second degree, and a postgraduate doctorate degree. So join me in welcoming Dr. Adedipe, who is a veteran board member. He sits on the various boards across several industries and sectors. Today, he will be sharing with us some of his thoughts around 2025, and where we draw insight both for businesses and for individuals to ensure that we make 2025 a year to be glad to be in. So welcome once again, Dr. Adedipe. Welcome.
Thank you so very much. Okay. The Group CEO, Directors, Senior Management of FirstBank, and okay, thank you. Ladies and gentlemen, the audience present here in person, and those on the virtual platform, I say a very big thank you to FirstBank for having me do this keynote this morning. Like I told one of my friends earlier, that I'm in good company when I looked at the panelists that we discussed the issues that will be raising. Interestingly also, the Nigerian economy has been a major topic of conversation, not just within Nigeria here, but indeed globally, and I will give you some few pointers to that. But more importantly, the fact that each time I sit back to think about our economy, I identify three constituencies. Number one are those who analyze the economy for the perspective of professional economists who either want to critique or want to point out areas where there are gaps here and there and what can be done to fill the gaps. Second constituency, policy advocates, those who want to engage the power, what I call talking to power, and how to get them to see the impact of the policy choices and decisions that have been made and what needs to change in that regard. The third constituency mostly are those of us here this morning, and that is those who are interested in the trends, the interpretations, and implications for business, in which case they are looking out for business opportunities. And I prefer to look at it from that perspective. Now, in general terms, when I look at the Nigerian economy on the one hand, and then look at what is happening globally. So I ask myself, Nigeria is in the category of developing countries. On occasions, we say it's one of the emerging market economies. But what are their peculiarities? I found three things that stand out for them when you compare them with the advanced economies. Number one is what I call food deficit. And when you look at the advanced economies, and look at those who have emerged in the last 20, 30 years, you find that they have effectively dealt with food deficit. So in which case, that is a major area of challenge. So for me, therefore, in looking at the Nigerian economy, I will ask myself, how do we deal with the issue of food deficit? With an estimated population of over 230 million Nigerians today, that is quite some challenge. Secondly is energy deficit. You can't power an economy without sufficient energy. So there is no growth that can be robust enough to take care of what we normally describe as inclusive growth, sustainable growth, and sustained growth. Those are the three active words: inclusive, sustained, and sustainable. The third one is manufacturing deficit. And I picked that specifically. Each time I look at countries that are rich and those that are categorized as poor, I found a common denominator, and that is manufacturing. And how does it play out? The poor countries, quote and unquote, they produce the raw materials, low value added, which of course they export to the advanced economies. Those ones process, they add value, and then they export back to these countries, but of course at higher values. So in which case, the value they attract when they export resources is much lower than the value they part with when they import, manufactures. And so for me, each time I look at the Nigerian economy, I always want to focus on those three areas of deficit: food, then of course energy, and then manufacturing. But as I look at those deficits as well, I advise myself that they also represent opportunities for businesses. And I will speak to that later. Now, when we talk about comparisons, there are two ways we do that. First is internal comparison, which means how has the economy fared in 5 major macroeconomic metrics. In fact, this is very popular internationally. Each time we are comparing countries, we look at their GDP in terms of size and in terms of growth rate. We also look at their stock market performance. How is the stock market performed in the previous year that we are looking at? Then we talk about core inflation. But when we come to Nigeria, I say, no, we can't look at core inflation. Because core inflation excludes food and energy prices. All right? So for the advanced economies that don't have challenges in the area of food and energy, which I mentioned earlier as deficits, we deal with here. Core inflation is more important to them than headline and food inflation. But for a country like Nigeria, food inflation is very, very fundamental. In fact, it's a big number in our headline inflation. In fact, if you look at our data in the last 3 to 5, 6, 7 years, food inflation has been trending upwards and faster than headline inflation rate. And of course, we talk also about unemployment. And lastly, there are 5 of them, as I said. Lastly is government deficits. So what is happening in these areas locally, and what is happening when you compare Nigeria with peer countries? We've had so many over the years, with different acronyms. But this morning, I want to draw our attention to one important thing here. Each time we look at the global economy, we identify challenges variously. I put 9 of them on a chart that I have here. And those 9, of course, I won't speak to them, but raise a most important one among them. And that is, oftentimes, we look at geopolitics. But this particular year is taking a new turn because a new president will take office in the U.S. a couple of days from now. And of course, everywhere around the world, there have been projections, expectations. How will President Trump 2.0 go? And how will he relate with China? How will he deal with the rest of the world? What about his pronouncement before he won the election? What did he say about tariffs? How will he deal with China? How will he deal with Germany, Mexico, Canada, and the rest of us around the world? And of course, you come around to talking about what this will mean for global trade. And how that will also impact some major macroeconomic indices, not only within the US, but across the rest of us. But I also like to say something here, and that is, oftentimes, we ignore what is happening with China. And yet China is the prime mover of the oil market. Because anything China does today, in a matter of hours, you see the impact on the oil market in terms of price movements. So an announcement of fiscal stimulus by China immediately moves the stock markets all around the world and also moves the oil market in terms of prices and, of course, positioning in there. So in my own thinking here, what I said is there are 3 economies that anybody doing business in the world must take account of in 2025. We cannot ignore the Chinese economy, as I just said, because the Chinese economy affects the hydrocarbons market. Then we can't ignore the US, anyway, largest economy in the world, and of course the strong place of geopolitics in the choices of the incoming Trump 2.0 administration. And of course, the Indian economy. And why do I say India? Of course, the most populated country today in the world. Not only that, ramping a growth rate that is significantly strong. Of course, you can put it as more than double Nigeria's GDP growth rate. And of course, also reforms that have been successful, from which you can learn our lessons in terms of not only reforming but sustaining reforms. And that is the real challenge Nigeria faces in 2025. Then, of course, the transition to green economies, and of course, intensified digital transformation, emerging markets, and probably what most of us have not even thought about, what I call the Generation Alpha. Generation Alpha is redefining the way decisions are made, the kind of products and services consumed, the outlook to investments, and what businesses should begin to think about. So, for us, therefore, in looking forward, and I will stay with only one slide now in talking about the Nigerian economy, what has happened in 2024 and I will pick on those 5 major metrics. The Nigerian economy has grown at least on an average of over 3% the first 3 quarters of the year, as mentioned a short while ago by Mr. Alebioshu. And we all have the data anyway. What are the projections? We projected that by the end of 2024, that is when the data for 4th quarter comes out, we see an economy that will likely end at about 4.12% growth rate for 2024. Now, if it grew at that rate, by any standard globally, that growth rate is significant. Because people often think 3% growth rate is small. But by any standards globally, growing at 3.46, 47, 49, 4.12% is quite strong. But the challenge for us is that growth has come mostly from services. So for those who think also the growth numbers are not that reliable, I also remind them that the reason it will appear so is because that growth came mostly from services. And that loops us back to where I started from. That is deficit in food and manufacturing, which of course are the two major sectors that can drive inclusive and sustainable growth. Then of course, I will come to the issue of the one that everybody is interested in, and that is the exchange value of the naira. And what I want to do here is remind people that oftentimes when we dissipate energy analyzing the exchange value of the naira, we tend to forget that our rate we look at is driven by some factors. First and foremost is the demand, supply, and exhaust. And then in between are many other things. And I'll put it simply this way. For us in Nigeria, the major drivers of the FX rate are, one, the structure of the economy, where largely we consume what we don't produce, and then we produce what we don't consume. Now, what are the chances that that can change in 2025? A reference was made to that earlier on also. There's expanded capacity for local refining of crude oil, in which case about 39% of the value of a merchandise import is likely to turn in 2025 as we refine more crude oil domestically, in which case the pressure that portion brought into the FX market is likely to subside on the one hand. Then, on the other side, I've had people also say, well, if we provide crude and sell in naira to domestic refineries, how about the loss in terms of export earnings? But my take on that is very simple. Go interrogate the data. You notice that for over 30 good years in Nigeria, the provision for domestic refining had always been a first-line charge on our oil production. It's a figure that is steady, 450,000 barrels per day. So it is the net that we had accounted for as exports over that period of time. In which case, if you provide that 40,000 barrels per day for domestic refining, it has no impact whatsoever on your export figure. Because it's a constant figure in our oil data in Nigeria. So in which case then, if that happens, then it means refined products not only will be available locally, and as I said, that also the demand for that drops out in the FX market in terms of demand. Then of course, on the other side, are we producing more? Yes. The data we saw yesterday morning shows that we're doing about 1.51 million barrels per day. That's the latest data we saw yesterday, waiting for both NNPC and the CBN to confirm that. But we got that from Reuters yesterday morning. So in which case, we are producing more. And why is that so? Two things. Number one, leakages are being blocked in terms of oil theft being reduced. There is also proven data in that regard. Secondly, is the fact that we are also now seeing those OICs that were exiting actually selling their oil assets to domestic operators, who are now venturing to produce more crude oil here than the OIC had abandoned. At some point in 2024, about 68 oil wells were capped. It's wells dug, proven crude oil that could be brought out from the ground, but those wells were capped. Now, as some of those are part of the assets transferred to local operators, they also are coming gradually into part of the market that we see currently. Now, let me move on to the MPR and, of course, the interrelationship with inflation rate, which Shegun also mentioned earlier on in his opening remarks. Now, usually, and that has been the pattern, the CBN will make the argument that the reason we continually push up MPR is to fight inflation, because it drives inflationary pressures we need to make subside. And what we have also found in our own analysis is that inflation in Nigeria is largely structural in nature. And because it is structural in nature, only about 37% of the inflation we see in Nigeria can be explained by changes in interest rates. That's what the data says from 1960 up until 2024, when you interact with the data in different ways. So in which case, to solve the problem of inflation in Nigeria requires more than ticking up the monetary policy rate. There are things to be done with respect to food inflation in particular. 4 elements in there, but the first 2 of them are very, very important. The first is food availability, and the second is food affordability. For that to happen, it means Nigeria must address the causes of food deficit. And that is primarily, 1, security, which of course became accentuated since 2017. There was an occasion like this in 2017, January, when we started a note of warning to our government of the day that the issue of insecurity needed to be addressed, or else in a matter of a few years, Nigeria will be struggling with food inflation that has become a reality today. So how do we deal with that? So that needed to be addressed, insecurity. That's 1. 2 is that 60% of farm output goes as what we call post-harvest losses. And why is that so? Storage inadequacy, processing inadequacy. And for me, it is not about government investing there, it's an investment opportunity for private sector operators. That is food processing and also storage, which is a major. Now, just last week we read about one of the state government, I think Ekiti state government, is actually taking steps specifically with respect to those issues. And that is irrigation system, then of course storage, and also trying to woo investors into processing. Now, which means that we need to create an environment conducive for investors within those spaces. Now, if we do that, we will go some distance in addressing food deficit. Then comes the issue of, one of our friends here asked me a question before we started this event. And he said, what do you think about where will the exchange value of Naira go this year? And I said, my expectation is that the Naira will lose value, but very moderately. In fact, our projection in our firm is 1574.4 Naira to the dollar for this year. And our reason is very simple. When you look at the factors that drive that, but what came out strongly is that if the economy is going to grow as we expect this year, certainly there will be some pressure in the FX market, no doubt, because most of the inputs for manufacturing to start with are still imported, okay? And then secondly, we still import a lot of things that we consume, even though some analysts will argue that Nigeria doesn't import enough, especially when you compare to our GDP. But I also remind analysts that ratios can be misleading, because a change in either the numerator or denominator will bring a change in the ratio. We therefore should ask ourselves, what are the drivers of those ratios? So then comes the issue of business climate. And that's when you look at the Purchasing Managers Index. Interestingly, the one that the CBN published recently shows clearly that Nigeria has turned the corner as of November 2024. Because the PMI ticked above 50. 50, of course, is the benchmark, where above it, business confidence is growing, in which case purchasing managers are placing orders that indicate that they expect over the next 6 months, threshold, they are likely to have more orders from for what they produce. So that is a positive signal for Nigeria and the economy in 2025. Now, in our own argument here, the exchange value of the Naira can only be challenged beyond what we project if there is any reason for investors to develop cold feet. And the reason is simply this. Now, when you look at our external reserves, at about $42 billion actual, 30-day average about $40.8 billion. When you compare that to our merchandise import bill, that gives you about 12 months cover. But I also did something for the purpose of this event. And that also brings what we call, I don't want to label it as a lie, but misleading interpretation of data. Each time you look at the months of cover of external reserves, the IMF will recommend that once you are about 3 months cover, there are chances that your currency will remain stable over the near term. All right? Nigeria has about 12 months cover. That gives us some kind of confidence that Naira will remain stable. But when you pair our external reserves and ask yourself what makes it up, then you find the following. FPIs, that's foreign portfolio investments, are in there in large number. Loans also dominate our capital importation. All right? Of course, as we always argue, loans are not paid the same day that they are taken. So we are also very circumspect when we interpret loans. Then, of course, we come to FDIs, and that is what Nigeria really needs. So if we don't manage business confidence, there may likely be a resurgence of speculative attack on the currency. And that is what can make Naira lose value in 2025. Which is also why the reforms that we have seen in the last 2 years need to be sustained. Sustenance of the reforms is a positive signal to investors, and therefore we expect that it will likely remain. Where do we expect MPR to go? We had some great guidance from the central bank governor, who said that inflation is still worrisome to the central bank. We may therefore not expect MPR to tick down in the first quarter of this year, but we expect from the second quarter that MPR may begin to go downward, but nothing significant. So expectation for this year, therefore, is an MPR that is still above 20%, but in the range of 22 to 23.5%. That's what we expect. So nothing significant, because you don't also want to create a situation where the Naira asset that became attractive because of MPR that went up to 27.5% will not reverse and make FPIs to troop out of the country. So we expect that there will be some moderation there. That will also moderate banks' lending rates. We don't expect the rates to go anywhere below 30%. We are looking at about 31.5% lending rates in the banking system. Now, when we look at the final point I will make here, because I have just 5 minutes left, and that is to take a quick look at the budget. Now, when we look at the budget this year, we've had all manner of comments. 47.8 trillion, significant figure, Naira-wise. We haven't seen that kind of figure ever in our history, no doubt. But when you convert to US dollars, yes, it's also high in relative terms compared to some recent years. But it also will now become insignificant when you compare to other African countries. Take South Africa, take Kenya, and maybe Egypt. So it will appear we are not budgeting enough relative to our population. But again, look at the Naira value, 47.8 trillion Naira. That is the expenditure side, revenue side, and then the deficit. That looks back to one of the 5 key elements I mentioned at the beginning. That's government deficit. What we look at there is deficit vis-a-vis GDP. Now, in the last 2 years, in fact, 22-23, Nigeria did 5.1, then 7.5% deficit to GDP, which is quite high by any standard. Okay? We don't yet have the conclusive figure for 2024. But that figure also, we don't expect that anything less than 7% for 2024. So now, if that is the case, the question we ask ourselves is this. There's no problem with borrowing. We want to know what you are borrowing for. That's number one. We also want to know the sources, that is the funding of the deficit. When you look at our foreign debt, you'll discover that about 48% actually is multilateral. And that is very cheap. We call them concessional loans. And of course, if you look at the other side of domestic debt, and that's one thing I want to also highlight here, that most analysts often ignore. Most of the domestic debt are federal government bonds and treasury bills. And then who are the major investors? They are mostly Nigerian entities, mostly. In which case, what we see on the deficit side of what government is paying out as interest is actually coming to mostly Nigerian entities. So in which case, the value is still within the system. The only challenge I see there is that we are only creating financial value. And that's where the disconnect is. And that takes me back, and that's where we conclude that, number one, we expect reforms to be sustained, and we expect some moderation in NPR, not insignificant. Naira, yes, we lose value a little bit from about 1.5 thereabout officially, still with less than 1,600. We projected 1,574.4, as I said earlier on, for the reasons given. And of course, in terms of what we see for interest rates, I've also mentioned that inflation rate is not going in the direction that Mr. President said. He said he's expecting 15%. I think that's a very, very ambitious expectation. Our projection is end of 2024, about 33%. And for this year, we're looking at anything around 27%. Don't forget, an economy growing, we also mount inflationary pressures. So if the economy is going to grow, that will create some pressures on its own. And of course, with Naira still at 1,574 thereabout, that will bring some inflationary pressures as well on the other side of the equation in terms of imports and such things that we consume or use in manufacturing. So all well and good in our own expectation. 2025 for the Nigerian economy is a year of recovery. Now 24 has proven to be a year of resilience. We see 25 as a year of recovery, where opportunities are diverse. The question is, where do you see the opportunities? And what do you do to take advantage of them? And I will drop that as my last line. If a Saudi Arabian firm saw opportunity in agriculture in Nigeria, and we buy out 51% stake of Olam, and return to say we want to buy everything, certainly there's something that entity saw in the agri space in Nigeria. And again, several others are within that space. In fact, there are a number of companies I got to hear about toward the end of last week. I was outside of the country, that we are interested in what is happening in 10 different subsectors of our Greek sector in Nigeria. So, but I will leave it there because my time is up. There will be a lot more to interrogate during the panel discussions. Thank you so very much, ladies and gentlemen. God bless you all.
Thank you so much, Dr. Adedipe. That was very insightful. And we are going into the next section of the program, and that is the panel discussion. That's actually where we assemble some of the best breeds and in the industry. So thank you, Dr. Adedipe. We have the virtual participants already posting questions. We'll address those questions. But permit me to welcome our panelists. As your bank that emphasizes quality, we've assembled veteran quality industry analysts and commentators, as well as practitioners in several industries. So permit me to welcome our first panelist, Bismarck Rewani. Bismarck Rewani is the Managing Director and Chief Executive of Financial Derivative Company. Is a macroeconomic and research and financial advisory firm. Bismarck, as we know, is a regular face in the Nigerian and in the global industrial world. He's got over 40 years experience within consulting, banking, economic research, and he comes to us with significant experience in this space. Bismarck sits on the board of several organizations across several industries, financial services, the real sector. He is also helping out in the academia. Bismarck anchors the executive breakfast show of the Lagos Business School. So welcome once again, Bismarck. We look forward to getting excellent insight from Bismarck for today. Our next panelist is Osaho Ogere. Osaho is a group head within the Corporate Banking Directorate of FirstBank. Osaho is an accomplished banker. Osaho comes to the table with significant experience managing customers' businesses, advising customers with significant value-add services. So welcome on board, Osaho. Our next panelist is no other person than Ugochukwu, who is popularly known as Ugodre. Ugodre is the CEO and founder of Nairametrics. He's a regular commentator within the Nigerian financial services space. Above all, he's got a penchant for expressing financial data in a way that the consumers will appreciate and have a good understanding. He's also a member of some of the professional associations. He's a fellow of ICANN and has a very good hang on macroeconomic analysis. He's been engaging across both the print and TV media. So welcome, Ugodre. Ugodre, welcome. Permit me again to call back our keynote speaker who will be joining the panelists to interrogate some of the things we want to discuss today. So I welcome Dr. Adedipe once again. And we have one of the best in the industry, within the investment management industry. So welcome Ife Oluwa. Ife Oluwa Oladepo Dixon is an accomplished portfolio manager. She's got specialist experience across investment banking, pension fund administration, insurance, and asset management. Ifeoluwa is currently the deputy director within the First Asset Management Company, a sister company of FirstBank, and a member of the First Holdco PLC. Welcome, Ifeoluwa. So you can see that we have selected the best breed within each space that has relevance to our customers. So they will be joining me today in the panel discussion. So permit me to take my seat while we kick off with the discussions. I need each of the panelists to have a mic. Thank you. Path to economic rebound and recovery. I'll be starting, let's start off with Bismarck. With significant experience within the industry. So we would like him to share his thoughts around some of the things that are happening in the macro environment. Bismarck, you recall that the federal government has indicated interest in continuing with the implementation of some of the reforms across both the physical and economic reforms that is happening. From your professional view, how would the key government physical policies and economic reforms affect the business environment in 2025? Some of those things have been touched by Dr. Adedipo, but I would like you to give us some of your views around how those reforms will impact the economic environment this year.
Good morning, ladies and gentlemen. Again, I'm happy to be here, and it's an honor and a privilege to have this opportunity. I think that Dr. Adedipo did justice to this discussion this morning by projecting what he thinks will happen in 2025. But I want to discuss this in the context of business opportunities, and more than anything else, the fact that, like I said somewhere else, that 2025 is not a year for the faint-hearted. It's a year in which there will be a big distinction between those who are strategically thinking and those who are reactively thinking. I think that 2025, the opportunities will be that those who do not believe that that the momentum of the past will continue into the future, that the fundamental principles of economic theory work in every market, whether it's Nigeria or anywhere else. I think that's the first thing. Secondly, that the closer you get to equilibrium, the less volatile and the less traumatic the changes that are going to come thereafter will be. Therefore, and one major element of the analysis which Dr. Adedipo did not treat, and most analysts have not treated, is what we call the if-what analysis. If you did not do what you did, what would it have been? Because everybody says, okay, you reduced subsidies. You reduced the differential between the multiple rates, between the parallel and unofficial rate. You reduced the amount of the difference between inflation and your treasury rates. You did reduce the difference between the petrol price in your neighboring countries and yourself. So when you look at all of this, and there are about 9 or 10 variables, you see that the difference between what is an equilibrium price and what is our managed price actually reduced. And that the various steps that are going to happen in 2025, the changes that are going to happen are not going to be as magnified or as significant as it was in the previous years. Therefore, the impact, what I call a normalization of the change, right, is not going to be as severe as was anticipated. Secondly, the fact that things have been difficult does not mean that they'll be difficult thereafter. So I want you to put these two things in perspective. One, the fact that if we did not do what we did, where would we have been? Two, the fact that you are closer to equilibrium means that the changes that are going to come are not going to be as wild and as painful as it was in the past. And I said publicly that 2025 is going to be less hard, less painful, less difficult than 2025 will be less difficult than 2024. So, and that anything else, and we talked about inflation as well. Some data is coming out this week, I think, for December inflation. And we went to the market 2 days ago and we looked at various prices. And very interestingly, also, we saw that 23% of the products, 46 products that we measured, showed an increase. About 25% of those products also flatlined. And over 50% of the products that were covered actually showed a decline. And you would see from, if you analyze it further, most of the ones that showed declines were perishable goods. Those that stayed flat were imported, had major import content. And those that increased were things that we had a cost effect, and logistics costs were most prominent. What does this tell you? And I'm coming back to the opportunity, which is the question. What it tells you is that more than anything else, one, there are factors that are leading to some moderation in inflation are one, the price of petrol and diesel, which has not increased further but actually declined. Two, exchange rate stability, which had not gone further than expected. But the most significant element, though, for us was consumer resistance. That consumers now are facing a major trade-off between income effect and substitution effect in their buying power. So for a manufacturer and for those who are producers of goods and all, you have to think of yourself as how much costs can I push to the market? How much am I going to absorb? And what is going to happen if there's further consumer resistance? So what is my efficient pricing model I'm going to adopt? And I'm producing at where my marginal cost equals my marginal revenue. Good. But more than anything else, what is happening to my average cost of production? Because it is the difference between your average cost and your average revenue that determines your profitability. So I think this is where everybody has to look at 2025 to see the trend of inflation and when interest rates are going to start declining in the second half of the year. You are going to see where the exchange rate appreciates a little bit, becomes more volatile, and then appreciates further depending on factors like the oil price and various things that are happening in the international markets. You are going to begin to deal with public debt. And when we talk about public debt, we're talking about what it means, because you are borrowing to produce. You're also borrowing from the same market as the government is borrowing. You're also going to think about at what rate of interest Nigeria is going to borrow both concessional money, when it can get there, when it can get it, commercial debt, and the effect of all of these things on your own cost of borrowing. Also, remember that every year that passes since 2018, 2019, when the currency started dropping sharply, we have actually been using assets that we bought at the old exchange rate. And those assets have now probably exceeded their depreciable life. So at what cost are you going to replace those assets? And are you going to be able to use your current pricing to amortize the new price of assets, capital assets that you're going to be using? And capital assets that are relevant and functional in the new world. I think those are the key things that you're going to have to decide. Your pricing, your positioning within your market, and more than anything else, we've seen the recapitalization of banks and all of that. But it is not the capital of the banks or the capital of the companies that are going to replenish their capital because of exchange rate losses. But it is the intensity of rivalry from global players, right? And the shift in the bargaining power, within those industries, especially financial services, especially manufacturing, and especially those who are competing with other African manufacturers. So there's a lot to talk about, but I just thought I'll put this on the table for us to think about, because this session is actually to provoke thought, not to provide answers. Thank you.
Thank you so much, Bismarck. That was quite insightful. Bismarck, before I come back to you, Ugodre, let me turn to you right now. We've seen, driven by significant awareness in climate change, we're beginning to see increased interest by both corporate and sovereign in climate-related issues, in clean energy, in renewable energy. Just from your perspective, what does this mean for an average Nigerian business or investor? And what kind of opportunities do you see within this space for both impact and revenue generation for both government and the corporate investors? Thank you.
Thank you, Chike, and good morning, everyone. Happy New Year. Thanks for having me here. Also a pleasure to be on this amazing panel. This is your question now. Wow. I think that maybe let me take it from the point of view of a regular Nigerian. Let's say 2-3 years ago, climate change really didn't mean anything to a lot of Nigerians, and the reasons why it doesn't mean anything, because for us in Africa or sub-Saharan Africa, what we're interested in is how to put food on the table. Nobody is worried about climate change and some of the connotations that the West tries to put forward. And even from a government perspective, and I'm not just talking about Nigerian government, even across Africa, I think the view is that for Nigeria's or for Africa's manufacturing independence, climate change shouldn't really be at the forefront of our own discourse, because we do need energy for us to industrialize. And so for most of the industrial countries, whether it's China or the US, they have used their own fair share of energy to boost their own industrialization. And even today, the energy that is used for the computing power of AI is probably 10 times more than the energy we consume in the whole of Africa. So from a diplomatic or from a strategic standpoint within Africa, climate change is not really that much of a big deal. But a lot changed last year, and it's not because all of a sudden we just think climate change is a priority as Nigerians. We somehow have found ourselves in a space where we have no choice but to take it seriously. And the most important factor was the removal of fuel subsidy, and also the increase in electricity prices. So those two factors, more than anything else, now means you have to be energy conscious, how you consume power. And so from a cost perspective, Nigerians are now forced to manage how they consume electricity, and that goes a long way in also helping us meet some of the climate objectives that you have globally. And so for Nigerians today, people now manage how they drive their cars. A lot of people who have 3 cars or people who have fuel guzzling cars now prefer to use a Toyota. In fact, me, I had to buy a Toyota Camry just recently because I realized for most SUVs, you probably have to fill your tank with 90,000 every three days or so. But with 60,000, you can drive a small, maybe a Camry or something for a week or two. So from that perspective, people are a lot more energy conscious. So what that has also done is unlock investment opportunities. And if you speak to people in the renewable energy space, they will tell you that more than ever, they recorded significantly high adoption last year, whether it's for solar-powered electricity or anything that can actually help reduce either the cost of buying fuel or cost of powering their houses. So, and I think that is where we've seen investment opportunities across. Today, if you wanted to buy maybe a 3 or 4 kV solar, powered inverter, what tends to happen now is that a lot of the guys who produce these things have several facilities in place. Some of them get some of their funding from commercial banks, some even microfinance banks at very significantly high interest rates, and then now sell to customers who they allow to pay over time. So it kind of gives you an idea of the kind of demand that's going in that space. And of course, there's also capital inflows outside Nigeria that is pushing towards the renewable space. Now, the other area where we also see interesting developments is with EVs. I think the first EV in Nigeria was probably in 2021, and there wasn't so much noise around. I think it was Stallion Motors or thereabout. But last year, Innoson also, launched its own EV. We've also seen some of the Chinese-made, cars in Nigeria or assembled cars in Nigeria also launching their own EVs. We're still a long way from it because we don't even have light to power television, not to talk of EVs. But I think increasingly, if you also monitor how Gen Alphas, like you mentioned, and even Gen Zs, a lot of the conversations they have on social media, they are very, very interested in EV-driven vehicles. So I think we're basically at the cusp of essentially adopting a lot of the climate change narratives that you see happening globally. But that is not because we think climate change is a strategic option for Nigeria, but just a cost-driven need, and that's why you see a lot of conversation going on there. And I think there's also one other part which maybe I won't expatiate on too much for sake of time, which is attracting investment. So right now, for a lot of organizations looking to tap into foreign investments, either through loans or equity investments, climate change or sustainability is now one of those key factors that global investors look at. And so if you're trying to follow the money, then I think it's always important that organizations or companies align themselves with sustainability requirements. And then lastly, we have a new government in the US, and so a lot of the talk around climate change might not be as loud as it was 2 or 3 years ago, because Donald Trump is not so much of a fan of climate change at the moment. Thank you.
Thank you so much, Ugodre. Osaha, I will turn to you right away, and that was quite insightful. Again, in Nigeria, where we continue to see people seeking alternative renewable energy sources, especially to power offices and houses, and that's quite critical. And that brings me to a question around some of the things FirstBank is also doing within that space. FirstBank is deliberately supporting and promoting businesses and individuals who want to seek alternative, efficient energy. Also, that brings me to a question I would like you to address. We see across both economic analysts and the monetary authorities, we see some pronouncements around non-oil export as a major driver, or one of the major drivers for increased first liquidity and exchange rate stability. And from a business standpoint, there's also significant revenue opportunities for businesses who intend to go into non-oil exports. I mean, as an executive in FirstBank, how is FirstBank specifically supporting businesses who want to explore or who are even doing non-oil exports? And what are the specific propositions FirstBank will promise or putting on the table for customers or potential customers within that space?
Thank you, Chike, and good morning, everybody here and those who are online. Quite a pleasure to be here. FirstBank takes the issue of exports as a very critical part of our business for many reasons. Apart from the non-oil export thing, if you are able to generate your own dollars as an institution, you are also able to offer these dollars to your clients at more affordable rates. So if you are supporting people who are exporting, the dollar comes to you through NSPs and you have them. So to address that, we have gone on a deliberate mission. The first thing we have done is establish a dedicated export desk. So we have an export business run by people who are very knowledgeable about the end-to-end parts of that value chain within our transaction banking division. Having established this team of competent professionals who work within the corporate bank directorate, we have gone ahead to see what products will really appeal to the market. Most times you talk to exporters, they complain about money, they don't have money to do their businesses. So we have gone ahead and said, okay, if the problem is money, we are in the business of giving money. And that's what we have structured the product that is actually priced below MPR. So in a market where MPR is 27.5, our export product is actually priced below that. So I think we should give FirstBank a round of applause for that. So having established that product, we have gone ahead to build capacity. So we are working with these exporters in capacity building. Anytime you deal with an SME, oftentimes you are worried the financials are not correct. So we are working deliberately with them to build capacities. If you go to our FirstBank website, www.firstbanknigeria.org, you will see our SME Connect. So much resources available. You can register for webinars. One of the biggest things we are also doing is using our leverage as a big systemic institution to engage different operators in the export business. We have very strong relationship with Nigerian Export Promotion Council, the Shippers Council. In fact, talking to some exporters recently, when I was talking to the desk officers, they said it used to take up to 6 to 8 weeks after your commodities get to the port for it to be taken onto the ship. Your cocoa seed will be at the port warehouse for 6 weeks. But what have we done? We had several engagements with the Shippers Council, and now many customers of FirstBank are able to get their products onto the ships within 2 weeks. And so we are leveraging, because if we write a letter to the Shippers Council as FirstBank, they will listen to us. If you write as Osahon Nigeria Limited, so we are using our might as a big institution and giving the benefit of who we are to benefit all those who ride with us. If we are looking at our database, we have over 1 million SMEs who are customers of FirstBank, and we are giving them various propositions and values. And if you look at this whole thing about export, you will realize that it's not only the SMEs that are even doing export, even the big corporates. I think Julius Berger is exporting cashew nuts. So, because everybody must get dollar to continue his business one way or the other. So we are providing expert support, we are providing advisory services. At a time like this, we are also looking at what kind of capital are you using. The Nexim, Nigerian Export Import Bank, has some facilities. We are collaborating with them and supporting our customers to assess these things. So we have a whole bucket. The appeal here is that if you are an exporter and you are not with FirstBank, you are still not awake. Please wake up and join us, because we will take you to the promised land.
Excellent. Thank you so much. So, sir, would it be right to say that FirstBank is the go-to bank
Absolutely,
for non-oil and other exports related businesses?
Absolutely.
Thank you so much. Ifolu, I will come back to you right now. So we've seen several reforms within the Nigerian space, and which potentially will impact the investment environment. Given that, what do you see as the trends? What are the potential trends that will shape the Nigerian investment management industry? And given that First Asset Management is one of the reputable industry players, what are the specific propositions, or what are the specific solutions that First Asset Management is putting forward and promising customers to benefit from some of these trends that we see coming up?
Good morning, everyone. And thank you for having me on this panel. Now, based on all that have been said, the panelists and the keynote speakers, you would agree with me that about 3 things have been reoccurring from all that have been said, and that's the energy space. The keynote speaker also mentioned agribusiness, and thirdly will be infrastructure. And these are the same trends that we are looking at, even at First Asset Management for our investors, be it retail, HNIs, or corporates that we do advise on a regular basis. When you look at the energy space, Ugo mentioned that, and that's energy transition. It's not really a thing of climate change or we're following ESG, but just because Nigeria happened to us in 2024. And so we're looking at renewable energy as well, and that's the trend that we're seeing, and that's where investors really, they latch on, would make money. In the agribusiness, and not just stop at integration, the keynote speaker mentioned storage and processing. That is another trend and a sector or a space that investors also can latch on to in 2025 to make money. And so when you're looking at your portfolio as an investor, retail or HNIs or corporate, you want to really diversify from traditional asset classes. And so you bring in alternatives. In the alternative space for First Asset Management, we have the infra fund as well. So in the infrastructure where there is a deficit, asset managers are bridging the gap in that area. And so for infra fund that we have, that also could help investors to bridge or narrow the margin between inflation and returns that we are getting from our investors, from our investments. And lastly, that I would mention is, and I think I've mentioned, is proper diversification away from asset classes. So you bring in commodities as well, like the agri-business that the keynote also mentioned, energy, when you look at infrastructure, fund as well, and I think you will be able to do well in 2025 in the investment landscape.
Thank you so much, Ifoluwa. Bismarck, I will turn back to you right away. We see some of the reforms within the Nigerian economy, particularly the oil and gas, as well as the agri space. Given those reforms, what should businesses expect, and how can businesses in Nigeria leverage the outcomes of those reforms to drive both business expansion as well as revenue growth?
Thank you. You talked about energy, that's oil and gas, and you talked about agri. I think you got to think of the context that policymakers in 2025 already position themselves for 2027. And therefore, it's not, James Carville said yesterday that we lost the election basically because of the simple thing that it's the economy is stupid. Now, nothing demonstrates the impact of policy more than output. Output in Nigeria is either food or energy. So oil and gas and agri. How will these two sectors perform in 2025? I said earlier that the price of oil determines the final price of refined products. But because the structure of this industry has changed, because you now have an oligopoly where there's intensity of rivalry among the players. In other words, government-owned refineries, modular refineries, and the Dangote refinery. So I do not see, now you have, as you drive along Victoria Island, you see 935 at MRS, 975 at Mobile, 1015, sorry, 10, whatever it is, Total. Now, means that there are multiple prices. And consumers are asking themselves, the difference between one price and the other is about almost 100 naira. And Ugo said about driving a Camry, but if you're buying 100 liters times 100 naira, that's a lot of money. So consumers are going to be making those decisions. We also noticed that earlier on, about 3-4 months ago, every time there was an increase in the price of petrol, we saw a reduction in traffic. Yeah. We also noticed, because we did vehicular count, on our Deola or Decook, for example, we saw almost a 25% reduction at the same time of the day in vehicles that are going through in one direction. But recently, in the last 3 months, we've seen 898, 900, 1,100. So the increases have become smaller and smaller. And the response of the market in terms of changes have been less. In other words, people have become less price elastic, right? Okay. Also, because the price of diesel and the price of petrol were major factors in creating inflation, right? We now saw that the rate of increase in inflation, which was going from leaps and bounds, are now smaller. We are projecting that inflation coming out at the end of this next week will be at 35.4%, right? Not as high. The spike is not as high as it was. Food inflation actually flatline, and that is December inflation. In January, we expect, because January prices are beginning to show, because that's when they pay school fees, that's when they, and they run out of cash. We see that January traditionally always drops. So coming back to the question is that output, energy cost, which is the major transmission effect on logistics, output, food prices. Now, we have this import waiver, which has been bureaucratically bungled. In other words, it was supposed to bring down prices of goods, but actually prices never came down because the goods came, and the opportunism in fixing prices as against actually bringing down prices. There was a disconnection between the goals of the policymakers and the goals of the businessmen. They were not aligned. Okay, so, but this is planting season. By the time you see the full effect of improved seedlings, improved fertilizer and all of that, it's not going to happen it's going to happen towards the end of the year. So we have to be careful about false expectations. The moderation in inflation is not going to be as much as is expected. I'm on record saying that the president's goal of 15% inflation this year is an aspiration. And people are free to have aspirations. But we deal in the world of reality. And therefore, we are going to be seeing more like 27 or 25% towards the end of the year with some luck. So, but again, what would it have been if we didn't do what we did? Right? Inflation would have been 45, 50%. So it could have been worse than this, right? But it's not going to be as great as we expect. So agric output, fertilizer output has increased to about 4 or 5 million tons. Improved seedlings, access to forex, right? Because one is availability of forex, the other one is the price of forex, affordability of it. Another thing that we must bear in mind is the difference between the inflation rate and the interest rates, which was wide 2-3 years ago when the treasury bill priced at 2% and inflation was 25%. That was about 23% differential. Now with 1-year treasury bills at about 29% effective yields and inflation at 35, the difference is only about 7%, right? So that, all of those things mean that we are getting closer to what we call general dynamic equilibrium rather than static and partial equilibrium. In economics, it means that you are going to be optimizing the assets, right? And the output begins to increase. Once output and growth begins to increase, after a while it begins to translate into welfare of people, right? But it takes time. So don't be carried away by the fact that the trend. And finally, I've just read Richard Schumer's 10 important trends for 2025, and he's the guy who wrote the Breakout Nations and all that. It's highly respectable, and he hardly gets it wrong. And he said something that the emphasis on, one, the U.S. as economy, and the power of the U.S. president has been overemphasized. And as a matter of fact, it's going to be such an anticlimax that what you're going to have under a Trump presidency is going to be more of, in fact, it will be Biden 2.0. In other words, it's going to be the same old, right? And that is very significant. I think you've got to bear that in mind. Thank you.
Thank you so much, Bismarck. That was quite insightful. Dr. Adedigbo, I will turn to you in your presentation. A round of applause for Bismarck for that insight. Virtual participants, please, you can start sending your questions because our panelists are ready to take them on. And please, organizers, we can start having those questions moved to the table. So, Dr. Adedigbo, you did mention several opportunities that 2025 we see. But one thing both individuals and investors are also thinking about, what are the risks and what are the challenges, and how would both individuals and investors and businesses begin to be better prepared to surmount or withstand those risks and challenges within the economy when they come in 2025? Your perspective, please.
All right, thank you very much for that. Now, when it comes to risk, the first thing that comes to my mind is the fact that some think we can see have some reversals. What I advise them is that we have reached a new equilibrium. And so the economy can only go forward. In which case, look at what has happened thus far. And then in your interpretation, you identify the opportunities, and key in managing the risk involved is speed. That means you need to take a position quickly. Otherwise, the risk of not moving quickly will crystallize on you and you can be left behind. Now, secondly, is what I term significant utterances of key government functionaries. They should be tracked and monitored, especially where it affects your space. So that when you hear anything said that can have an adverse effect on your sector, you also move very quickly to ensure you protect your entity and your business. And of course, there are instances as well. I'll put this now against competition, and it goes this way. Oftentimes, we lose sight of opportunities here that foreign investors see very easily. And we hear this repeatedly from them. So, and the question is, you can sit back here and think it is still business as usual. And somebody comes from outside Nigeria, in fact, and eats your lunch while you are watching the table. So there is that possibility from the kind of comments we hear from foreigners, some within the space in Nigeria, some outside. So, but for me, the critical thing here is your quick response and tracking of what is happening within your space, especially your industry. And I will give one live example without mentioning names. This is a Japanese entity that had opportunity of supplying 1,000 electric motorcycles to a logistics company in Nigeria. And then, incidentally, we work with for both of them. So it was like matchmaking them. And then this Japanese entity said, if we provide 1,000 electric motorcycles, how will they power them? And I looked at them and said, which one is wrong with powering? Now, a logistics company says, I need 1,000 motorcycles. You are talking about how to power the bikes. So what I bring out of that is, whenever you hear of opportunities within your space, it is risky not to move. and it is more beneficial to move very quickly and take advantage of it. So don't use the excuse of power is insufficient and the likes to say that you will wait until it happens. You need to make things happen. River basin authorities now are being revived. So what opportunity is within that space that your own entity can key into? You don't wait until it crystallizes. You can move in there and also take some advantage. Let me leave it there now.
Thank you, Doctor. While you hold your thought there, but I have a question from an audience. It says, due to energy and infrastructure deficits, how can MSMEs mitigate the rising cost of production in order to break even in the economy?
Yeah. Well, the reason I smile is because there are many MSMEs that are thriving. And I'll put it in this mode. You know, many years ago at the Nigerian Economic Summit Group, we used to share a joke with ourselves and say, if you want to invest in Nigeria, BYI. BYI means bring your infrastructure. So if you are going into any business, whether MSME or large business, there are basic requirements for success in that sector. If energy is a challenge, we just heard from FirstBank of existing facilities that can support MSMEs in need of energy to power their business. So for me, therefore, a serious business person will be resourceful enough to look at every opportunity available to source what is required to do business. I run a small business myself, over 31 years in business. In fact, I just retired from the business as a CEO, okay? So the 31 years, there were challenges to the business as small as it was. But we didn't throw the towel and throw our hands up, okay? Every serious MSME must recognize the challenges within this environment and therefore look for opportunities that we have had here at this conversation that can help them survive, you know, those challenges. That's the way I look at it.
Sorry, Chike, let me just chime in on that as well. For some of the MSMEs, I think what we've also noticed that very smart MSMEs are doing now is when they are renewing their rent for either their shops or kiosks or offices, the smart one look for where there are band A lines. When I mean band A electricity lines, because when you're in the band A zone, electricity is fairly stable, even though it's a bit more expensive. It's fairly stable, and they now combine it with the renewable energy, solar that I mentioned, and so they now don't rely on diesel power generators. So with that combination, that tends to drive down a lot of the electricity costs, and we've seen evidence of that happen. So I think, you know, for that person that is asking, just to also buttress his point, I think that's probably what they should start to look at. You have to really be smart now about where you locate your offices, the kind of appliances you also use in your offices, and then even try as much as possible to explore, you know, work from home. There are certain days that you probably won't have your employees come to work, not because you're a stickler for work from home, but because you're also trying to conserve energy costs, which these days is now a major input cost for most organizations. So those are just ideas.
Excellent. And that will be the right time for me to turn to Osaho. Osaho, manufacturing is been going through most of the presentation that Dr. Adedipe did as one of the major growth drivers. And we see that SMEs, talking about SMEs, play a significant role in some manufacturing spaces in Nigeria. Again, I know as an executive in FirstBank will have something for the SMEs, and especially those in manufacturing. What are the specific ways FirstBank is supporting manufacturing firms, especially SMEs who are in that space, and what are the specific offerings that customers should expect to come from FirstBank? Thank you.
Thank you, Chike. For a 130-year-old bank moving to the fabric of Nigeria, there are very few major corporates or manufacturing concerns that FirstBank was not a part of their history. So we have not just the capacity, but the support structures to help manufacturing businesses. And it goes far above just providing funding. We don't just support manufacturing concerns, we support the ecosystem that supports manufacturing. So we are supporting from the end of input suppliers, from the point of project finance, from the point of conceptualization. I've been involved in FirstBank when we went to a bush, basically, where you now have 9 million metric tons of cement being produced. Bush, it was a bush, forest. We are running from snakes. And that is what FirstBank really is. So we are partnering, we are partner banks. We are trusted advisors to the manufacturing businesses that we support. And of course, we support them with all forms of credits, advisories, all forms of support to their own downlines, uplines, employee supports in terms of loans and advances, salary advance. They are distributors, bulk breakers, we are supporting them. All the big telcos, the big manufacturers for cement, for flour, we are supporting them across the entire value chain. And that speaks to who we are as FirstBank. We see ourselves as part of the story of Nigeria. And we see companies that we bank as partners. And so when we talk about supporting manufacturing, we see ourselves as right in the heart of government policy and strategy. So we have discussed today about, I think Dr. Adekunle said 39% is what it is that will be taking off import bills if we don't have to import refined petroleum products. And in every one of these chains, in fact, for some of the new operations we have in the petroleum industry, we have dedicated desk for managing those relationships. So if you are a manufacturer and you are here and you are our customer, I'm confident you are already enjoying what FirstBank has to offer. If you are not yet with FirstBank, we are inviting you to come and see, because a trial will convince you.
Thank you, Sam. So, it's, do you think the offering is only for big manufacturing firms, or FirstBank?
No, for everybody.
Serves across.
Like I said, it's ecosystem support. We are supporting, if you are the big manufacturer, you have people who are supplying your raw materials, we are supporting them with trade lines, we are supporting them with whatever they need to get the raw materials you need to manufacture. When you finish manufacturing, we are supporting with warehousing facilities, stock replacement facilities. We are supporting you with farm loans if you need to do expansions of your factories. We are supporting you with overdraft or working capital. We are supporting those who are also buying from you as your distributors, as your dealers. We are organizing seminars, workshops in industry-specific areas. In fact, we'll partner with some of the schools to advise some of the people that are supplying you, because if your distributors fail, your cash flow mechanisms can collapse. So we make sure that they too are not failing. We are helping them make sure that they are keeping the proper books of accounts. We're just going the whole 9 yards to make sure we are supporting the entire ecosystem for the success of not just our bank, not just our customers, but for our country.
Thank you so much. Ifeoluwa, I will come to you right away. Within the next 12 months, it's been projected that we'll see downward trend, even though slowly, in inflation as well as interest rates. As a practitioner within a foremost asset management company, First Asset Management, what's your outlook for the performance of the bond market as well as the equity market for this year?
Thank you so much for that question. Again, in this room, we've been told that it's going to be a year of double side. First half, we'll still expect inflation to be high and also interest rates to be elevated at the current state. And towards the end of the year, maybe by late Q3, we should start seeing moderation in inflation and also interest rates. Because and so for us at First Asset Management, we told our line as well to say we do not expect the hawkish stance of the monetary policy committee to change in the first half of the year, and that's been Q1 and Q2. If at all, towards the end of Q2 is when we'll start seeing moderation from them when inflation starts to tame down. And so the same will go for the fixed income market as well. So to your question, when you say bond, we expect bond rates, T-bills rate to still be elevated because of MPR and inflation. But once we start seeing those two indicators moving downwards, then we expect bonds as well to start moving downwards in that direction, and T-bills as well. For equity, looking at the past 5 years data, if my memory serves me right, I think Q1 is usually the most exciting time for equity markets in Nigeria. Are we going to see the same thing this year? Yes, but not as aggressive as we saw last year or previous years. And we will see the buzz again early this year, Q1, down to maybe early Q2, on the back of earnings releases that will be coming into the space from March, really. And so people are taking position right now. And so that is what will give the appreciation that we're going to see in the equity market. And also as interest rates will be taming down, with all that we've read, if people are able to plug into the manufacturing system or sector, people go into energy, then we start seeing those companies that are aligned with the sectors that we've mentioned here doing well as well. And if they're listed, then obviously we should see appreciation in their own value as well. And so really for investors that are online and here as well, it's just a position. If you're looking at equities, then you start looking at those companies that we've mentioned. We didn't mention companies, but sectors that we've talked about. And the beauty is at First Asset Management, we have investor advisors that would help guide in the security selections, whether fixed income or equities, or how to diversify your portfolios really to enhance or optimize your returns that you have getting, which in a way we believe strongly that it will be close to inflation, if not surpass inflation. We have funds that have actually outperformed inflation, and working with us will just make you to, we say our slogan is, we'll let your money work for you while you sleep, and so we believe we'll be able to do that as well for our investors. Thank you.
Thank you. Bismarck, do you have some point to make there? Why Bismarck is trying to make his point? I have a question for you that will come from the audience. One of the audience has said, in the energy renewable subsector, do you advise startups, what do you advise startups and corporates who want to explore investment in that? After Bismarck's response. Thank you.
Yeah, thank you, Palua. I think from a market perspective, one can say something categorically that the supply of shares have increased because of recapitalization of banks. Some companies are going to replenish their eroded capital because of exchange rate losses, right? But the exchange rate losses of yesterday could become exchange rate gains of tomorrow. But one of the most important developments will be what we announced in a few days in terms of telecom tariff review. Two of the major telecoms are maybe about 12 to 14% of market capitalization. With a review of that and flatlining in power costs, you might begin to see some very interesting recovery in the earnings of telcos. If that happens for 2-3 years none of the telcos have paid any dividend or paid any taxes for that matter. That could be a major game changer. So one, we expect some correction of some sort early in the year because interest rates remain slightly elevated. But when interest rates begin to decline, we see two things happening. One, and whilst every 1% increase in interest rate leads to about a 0.17 correction, increase in corporate mortality and default rates. The opposite happens when interest rates begin to decline. You begin to see a recovery, and some of those loans that have been provided under impairment strategies begin to get right backs. So bank earnings begin to get better, telco earnings begin to get better, power costs begin to moderate, and that's a recipe for a recovery in the value of financial instruments. Don't forget that short term people look for direction, long term they look for value. Thank you.
Thank you so much. Ugoju, I'll turn to you right away. We've been talking here, and one of the things that is coming through, while Dr. Adedekwe will respond to that, but I would like you to start thinking about this. Human capital development is one of the major drivers of growth, both at the corporate level and as well as the overall economy. I mean, from your perspectives, what are the things that businesses should start thinking about to be able to retain and attract great talents that will drive business growth? After Dr. Adedekwe.
All right, thank you very much. Now, when you look at the alternative energy space, I will use the word ecosystem. There's a lot happening there, and different business opportunities as well. There are those who provide the materials, that supply the materials. Some basically import them. There are those who assemble the materials. There are those who provide funding. In fact, if we speak now, the Nigerian Consumer Credit Corporation has two schemes. There's one they call CALM, one they call SCALE, which in fact have a lot of emphasis on renewable energy, either for offices, residential buildings, or even for mobile assets. So what you find in there are several opportunities for anyone that wants to invest in that space. I'm aware also of a development partner, a European, that put out $2 billion in that space, which currently I know some microfinance banks are signing on to be a part of, because I work in that space, so that's why I'm aware of this. And there are several others. It's a wide open space that anyone that wants to take advantage of opportunities there can easily find a place to plug in. So let me leave it there.
Thank you so much, Dr. Adedekwe. We are transitioning to focusing on the questions from the audience. So please, in-person audience, you can also ask your questions while we take some of the questions from the virtual participants. So if you have any question, please indicate by raising your hand. I have a question here for anybody from the retail banking business of FirstBank. I've got a question from an audience. Do we have any retail banking executive here? Okay, so while we wait for questions from the in-person audience, I will turn to some of the questions I'm getting from the virtual participants. This is for Bismarck. Bismarck, a participant would like you to shed light on the FGN bond waiver granted. Who were the major beneficiaries? What will be the impact to our domestic economy? FGN food waiver grant.
Okay, the waiver was for 150 days for many food commodities. The reality is that it was bungled. In other words, you needed a letter from the Ministry of Finance, you needed a letter from Customs, again, bureaucracy bungled it. The 150 days expired about a couple of days ago. Our sense is that since the benefit was not achieved, that to be extended. Because if you really want to fight inflation, you need to add some imports to the local output. But that's not the final solution. There's an output problem which needs productivity gains, it needs energy cost moderation, it needs improved logistics. So a couple of things, and there's no quick fix to an inflation, because inflation has both the structural part and its transient part. The structural inflation caused by impediments to output has to be dealt with institutional reform in the country. So not just policy change, but institutional reform. So I would say that we should expect, and I'm saying this as a guess, that there will be an extension of those of that 150 day, maybe for another 90 days or something like that. Will it have an impact in bringing down price of? Yes, it will have an impact because it's planting season, so you need to supplement that. Secondly, the final solution is increasing domestic output, which is land preparation, improved seedlings, fertilizer use, and then logistics cost of getting goods from farms to the market, and reducing post-harvest losses with storage.
Thank you so much, Bismarck. Ugodri, please, your thoughts around the human capital.
All right. Thanks a lot for the question, Chike. I think after COVID, the conventional thinking of a lot of employers is that the world has changed and remote working from nowhere just sort of took hold. And I think at some point, everyone thought remote working is, here to stay, right? Like that's basically what the world will look like. And all of a sudden, a few years ago, we started seeing changes. Even the big tech companies like Amazon and Google were now calling back, their employees. And so it gives you an impression that maybe perhaps power is now shifting back to employers. Now, another trend again that could likely also shape this relationship is the wave of nationalism that is across Europe and even in the US. And I'm speaking to JAPA because a lot of organizations lost a lot of their employees to favorable immigration policies that occurred just shortly, before and after COVID. So I think that trend is reversing. Immigration laws are being tightened at the moment, even though you're still seeing pushback from some tech companies. So you're still going to see a lot of people immigrate, especially those that are, talented or that have tech skills. But now let's just come down to another major trend, which is salaries. I think I was doing an analysis recently, Chike, and if you earn 250,000 naira 10 years ago, say in 2014, you know how much that was in dollars? That was like $1,250. So convert $1,250 in today's currency. That is basically what people were earning. People that were earning 2,050 naira a month were earning in 2014. So, and then now juxtapose it with what a lot of things that we've talked about today, which is the reforms that are taking place over the last 2 years. You've seen costs go up across board. Prices are now, like you mentioned, now at an equilibrium. So we're now in what you call a real market So a lot of the subsidies that we're enjoying are no longer there. And so what you now see happen is that employees will now start to find it difficult to cope because the government support that they all used to get is no longer there. So where else do they look to? They look to their employers to provide some kind of support. So I think one of the things that you see start to happen, which is already happening actually, is organizations now maybe, implementing some kind of PPP adjustment to salaries, because that's perhaps the only way you can compete or you can strive to retain your most important talents, whether from losing them to companies abroad, because we are now in a very global and nomadic market where employees can move around freely, or you probably lose them to your own competition. So I think that's perhaps one trend that I suggest employers start to look at. How do you start to adjust your salaries as well? Of course, without also increasing your operating costs. But mind you, prices are also going up. So if prices are going up and companies are declaring massive profits, then expect your employees to also, look forward to increasing their salaries. Now, beyond salaries, there are also other areas that I think organizations can start to tap into. And one quick one that comes to mind is consumer credit. Think about all the young people these days, maybe, guys who are 26, 27, and their early 30s, they just got married. You just got married, you're starting a family. Unlike maybe 10 years ago, you can, perhaps save your 6-month salary or use your upfront to buy a car or to maybe, pay your rent. So now your upfront can't even pay 20% of the cost of a car. So employees are going to be looking at their employers to help with whatever it is that they can do. And one thing that comes to mind is group discounts. So how do employers that have, maybe 5,000 employees or 10,000 employees across the country leverage on that size to talk to vendors that can provide some kind of facility or, buy now, pay later services to employees? I think that's going to be key to retention policies for a lot of organizations this year, because that's basically what is very important to most people now. And of course, let's not also talk about people who are looking for affordable housing. A lot of young people now can't even can't save to buy houses. It's not even possible, except maybe you want them to start to steal. So those are some of the trends that I think would shape your employee retention this year. And again, these things would always be driven by some of the reforms that you're seeing. Now, lastly as well, I also think that one of the things that forced subsidy removal has also done is, I think there is now a huge infrastructure need, whether is, in fact, more than ever, state government need to fast track railway connection across, not just in Lagos, but across the country, because people should be able to live in Yanokpaja and come to work on the island, because you can't afford a house on the island anymore. It's not just possible. And so that's really what happens with most cosmopolitan cities as well, not just in Lagos. So these are some of the trends that I think would shape employment this year. Thank you.
Thank you so much, Ugodre, and that's quite insightful. There's a question from the in-person audience, and I will take that to Bismarck, and I would also like Dr. Adedepe to give his view. We've been talking about reforms, but there's one reform that is almost here with us, the tax reforms. An in-person audience wants to know, what does this mean for businesses? And if you could shed light on what the impact will largely be for both businesses and as well as individuals. Bismarck.
Tax reform, like I said earlier, good economics but bad politics, right? So, but at the end of the day, is the economy stupid? Now, what do we expect to see? I think once you talk about tax, you have to go back to the 4 canons of taxation. It must be progressive, which means the rich must pay more than the poor. It must be neutral, that it does not distort the allocation of resources. It must generate revenue, and it must be easy to administer. Those are the 4 things that you look at. The tax reforms that have been, basically Nigeria's government is obsessed with revenue because they need to increase the revenue to GDP ratios and all of that. And so once it's easy to administer and generate revenue, those are the two factors that they consider. But the thing about revenue-intensive taxes is that by nature they are regressive. So because they are going to be benefit approach rather than ability to pay approach. And therefore, you are going to have this sales tax, this VAT things and all of that. But that is one thing, right? It also takes away money from consumers and gives it to government, right? And the second part of it is that what does the government do with that revenue? Is it transparent? Is it efficient? Right? And is it adding to productivity and output by doing certain things? Is the government multiplier as efficient as the investment multiplier? Right? So I think that is key. But you cannot continue to have an economy that is subsidies, because subsidies are reverse taxes. So there has to be an equilibrium somewhere where taxes are collected efficiently, not imposed, even though they are not increasing, but they are collected efficiently, and that the tax revenues are deployed and used for the benefit of the people. People must see it coming that way. But I think that it also means that unto him much is given, much is expected. So you have three levels of government. You have federal, you have state, and you have local government. So the local governments are going to be very, very important in the new dispensation, right? And so for banks and for corporates, your interaction in public sector is going to be more at the local government level and tracing the money. There will be accountant generals and auditor generals across all the local governments, right? So there will be governance and transparency there. So I think that it is a good thing, right? But it's a policy announcement that must be backed with institutional reform. That is reform of the tax collecting agencies, reform of the government that are going to utilize it in terms of authority to incur expenditure, and also monitoring the impact. We will not say that a budget is implemented because the money has been spent, because that's how it's measured today. So there are going to be many changes, but like I said, the longest journey in the world starts with the first step, and I think it will get there after the politics has been sorted out. It will get there, but the big work that is going to come is how to deal with government profligacy, right? And the global environment now is punishing governments that are profligate. I mean, if you read Rishi Chima's, Brazil is being punished because of excess expenditure and lifestyle of government officials. So it's easy to collect. I mean, it's difficult enough to collect taxes, but you must also have discipline on how to use it, and we must curtail government profligacy. Thank you.
Thank you so much. Before Dr. Adigbe, Dr. I would like you to spend just a minute, not more than a minute, in responding to your perspective. But if we look, there's a question from the audience. In all we've been discussing, and a participant in the audience would like to know what opportunities is this for private equity firms within the context of all that we've discussed. Just 1 minute respond.
For private equity firms, I think I will still stay on the sectors that we've mentioned, really, without, saying otherwise. So you look into energy company, right? Do you want to take stake in such a company and grow it with the company? Agribusiness as well. That is another sector. We've touched on storage and processing. We have maybe companies that are struggling, and if you have the cash and you want to go in there and manage things up from there, we've seen potentials in these two main sectors that we've mentioned, and I think now is the time for any private equity investor to go in and, put in the cash and grow with the company rather than when the company has grown. And that is when you see the potential. We were saying the potentials are there, right? And so just go in and put in your cash in it.
Thank you, Folua. So, Doctor, what is your perspective on the tax reform? Just a minute. We are running out of time.
Okay, thank you very much. Now, the first thing for me is the reduction in the number of taxes from about 62 at the last count we had to 9. That's a major, major gain of the tax reform. The second one is the way VAT proceeds are being shared under the current dispensation. That is also going to change, putting more money at sub-national level than we have currently, and not only that, also in terms of attribution, which means if I drink Coca-Cola in Katsina, the VAT paid on that will not be attributed to Lagos State because the headquarters of the company bottling it is Lagos. Rather, to be a portion of that will be attributed to Katsina, where it was consumed. That's a major shift that, in fact, make it more equitable. So, and those are the things I'll say for now. So many other issues, but because of time. Thank you.
Thank you, thank you. Osaho, I'll give you the last question. It's actually a question from the audience. He mentioned around non-oil export businesses. The audience wanted to know if in FirstBank, a company that is interested in going into non-oil business can open a domiciliary account with zero balance.
Yes, we have specialized products accounts where the opening balances could be zero. And in fact, we have accounts where we don't even charge fees, applicable fees, subject to certain terms and conditions. So all the person asking the question needs to do is to meet us at the end of the panel session, and we direct as appropriate.
Thank you so much, Osaho. We've got some other questions here, but what I would advise, especially from the in-person audience, the panelists will still be around for the next couple of minutes, so we can still approach them to interact, and even the FirstBank executives will be here to also take some of your questions that relate to FirstBank. So thank you so much for listening, and I thank my panelists for those insightful contributions, and thanks for listening, both the virtual and in-present audience. I will hand over to the Master of Ceremony to guide us to the closing remarks. Thanks.
Can we jam our hands together again for the panelists? I mean, you'd agree with me that the insights were practicable, useful, and things that we can take away from here. We do appreciate them. We'll give a few minutes for the photo session. Whilst they are finishing up with that, I'd ask kindly that the Deputy Managing Director of FirstBank, Mr. Ini Ebong, please get ready for the closing remarks. But just a few seconds so we finish with the photo ops. Media. Okay, we'll have all the execs also joining in the photo ops. Please wait a few minutes. All right, great. Thank you very much. Please, a round of applause as they take their seat. And then I'll welcome to the podium the DMD, Mr. Ini Ebong. Good morning.
Good morning, everyone. And I must say, today's session has been truly enlightening. I think very apt, given the time of the year, and as the panelists have pointed out, we're clearly facing some very interesting times coming forward in 2025. So on behalf of the board, management, and staff of FirstBank, I express and extend our deepest gratitude to everyone who has been part of the 2025 FirstBank Nigeria Economic Outlook. For all of you present in the room, for the teeming number of participants who joined online, to all our customers present, our colleagues and staff of FirstBank, we're truly thankful. FirstBank has been dedicated to this initiative over the years, and today you have all contributed to making the 2025 event truly memorable. The theme, Nigeria 2025, Path to Economic Rebound and Recovery, highlights our collective responsibility to driving growth and fostering resilience in the face of dynamic global and local economic conditions. I am optimistic that the insights we have all gathered during the sessions we have set today will set the tone for economic awareness that will guide our customers and other stakeholders on how to position themselves strategically for success in what promises to be a very interesting year of economic rebound and recovery. Over the years, FirstBank has remained committed to being a partner in progress for Nigeria's economic advancement. I remind you that's 130 years. Actively supporting businesses and individuals in navigating challenges and maximizing opportunities. Today's discussions have not only provided valuable insights into the trajectory of the Nigerian economy, but have also reinforced the importance of collaboration between policymakers, private sector leaders, and other key stakeholders in achieving sustainable growth. As we wrap up the event, I want to emphasize that while this gathering marks the official start of economic conversations for the year, the insights shared here today should serve as a continuous guide to inform decision-making and proactive engagement throughout 2025. Let us therefore take the momentum generated today into our respective spheres of influence and work collectively to ensure that Nigeria achieves the economic rebound and recovery we all envisage. Once again, I express our deepest gratitude to our guest speaker, Dr. Biodun Adedipe. He's truly a partner of FirstBank. We're truly grateful that we can call on you once again. Thank you very much, sir. Our distinguished panelists, Ugo Dre, Mr. Bismarck Riwani, Ifeluwa Dixon, our own Ifeluwa Dixon, and Osahon Ageva. Also, our moderator, Chike Uzoma. We truly appreciate you dedicating the time and ensuring that we had a very successful and engaging session. We're truly grateful that you graced our event and have shared your wealth of knowledge with us. We thank you all for your time, your presence, and active participation. And we look forward to partnering with all of you here, our customers, our guests, and all our participants online. We look forward to partnering with you on this path to shared economic success. Let's all have a prosperous 2025. Thank you very much.
And on that note, we have come to the end of this amazing, insightful, and thought-provoking session. I want to appreciate again everyone for being here. Shout out to all our attendees online. We thank you for being present and for taking away some of the thoughts and actionable insights for the year. My name remains Ademorayo Akpara, a proud FirstBanker. I wish you the best of 2025. Enjoy the rest of your day. Thank you.
For over a century, we've been growing to meet the needs of an ever-changing world, delivering unique solutions to help our customers reach increasingly bigger dreams, innovating to create an exciting new world of convenience and freedom, where what you can achieve is only limited by your imagination. Opening up new, more inclusive channels for commerce, empowering a new generation to reach beyond their dreams and grow into the giants they were always meant to be. We're helping to create a future where the possibilities are infinite, the opportunities borderless, and where the world looks up to Africa. Let's awaken the giant in you. You first. FirstBank.
We have created a future where financial solutions are more integrated into your world in exciting ways. From seamlessly managing your business to easily funding your lifestyle, First Mobile offers you an exciting bouquet of financial solutions that work seamlessly as you move up in your world or travel to expand your horizons. Let's take giant strides into the future together. You first. FirstBank.
Taking your business into the future will require a bank that supports you. That's why you need a partner delivering solutions tailored to you and your customers. With First Online, you can enjoy a seamless banking experience and a continually evolving financial platform to reach for even bigger dreams. Let's take giant strides into the future together. You first. FirstBank.
Being a student means there's so much of life to look forward to. It helps to have people who support your desire to create a spectacular future. That's why we developed Explore First, designed to give you an edge in your studies and provide lifestyle solutions that make every day a cruise. Step into our world. Let's take giant strides into the future together. You first. FirstBank.
Managing your finances can be simple with the right partner. That's why we are leveraging customer-friendly tech to offer borderless AI solutions designed specifically for you, so that wherever you're banking from, home or abroad, you can be sure of the dependable financial support with First Diaspora. Open a First Diaspora account online today. Let's take giant strides into the future together. You first. FirstBank.